United Airlines just reported the biggest revenue quarter in its 100-year history, $17.7 billion, up 16%, and its profit fell 17%. One line on the income statement took nearly all of it back. Here is how a record quarter and a $6 billion fuel problem collided, and why United raised its full-year guidance anyway. First, the setup. This is United's revenue over the last 4 fiscal years: $45 billion in 2022, $53.7 billion in 2023, $57.1 billion in 2024, and a record $59.1 billion in 2025. 4 straight annual records, and 2026 is tracking toward a 5th. Second quarter revenue came in at $17.7 billion, the best single quarter United has ever reported. All of these numbers come straight from the company's SEC filings. What makes the growth impressive is where it came from. United grew capacity, available seat miles, just 3.5%, but total revenue per available seat mile jumped 12.1%. Compound those and you get the 16%. In plain English, United is not flying that many more planes, it is getting paid meaningfully more for every seat it flies. Load factor held at 83.4%, so travelers absorbed double-digit fare increases without blinking. Management said it saw minimal to no demand impact from higher prices. Now, the other side of the ledger. Aircraft fuel cost United $5.1 billion in the quarter, up from $2.8 billion a year ago. That is a $2.3 billion year-over-year headwind in a single quarter, almost exactly the size of the entire revenue gain. And for the full year, management now expects fuel to cost nearly $6 billion more than it assumed back in January. So the profit line went the wrong way. Operating income fell from $1.3 billion to $1.1 billion. Net income dropped 17% to $805 million. GAAP earnings per share fell from $2.97 to $2.46. On an adjusted basis, the number Wall Street actually watches, United earned $1.99, near the top of its own guidance and about a dime ahead of consensus. Record revenue, shrinking earnings, that is the fuel math. Here is why management is not panicking. Airlines recover fuel through fares, with a lag. United says it recaptured about half of the fuel increase in the second quarter, expects 80 to 90% recovery in the third, and full recovery by the fourth. The catch is the near term. The July fuel spike alone is worth about $1.12 of third quarter earnings per share, which is why the third quarter guide came in below street estimates and why the stock faded on an otherwise strong report. Meanwhile, demand is broad and premium heavy. Premium cabin revenue rose 16.4%. Cargo jumped 22.6%. Contracted corporate revenue flown surged 27%, with bookings up 30%. Loyalty revenue grew 11.3%, and even basic economy rose 11%. Internationally, Pacific unit revenue led the system, up 14%. This is the brand loyalty strategy paying off. Premium customers keep buying up, and business travel keeps coming back. And that demand is why United did something unusual. It raised full-year guidance into a fuel shock. Adjusted earnings per share are now guided to $9 to $11, up from $7 to $11. The low end raised by $2 full while absorbing that $6 billion fuel bill. CEO Scott Kirby went further. If fuel simply returns to early July levels, United expects to beat the high end of the range. The balance sheet shows how management played defense. When the Iran conflict spiked oil in the second quarter, United raised $3.7 billion of aircraft-backed debt at roughly a low 5% fixed equivalent, pure insurance. At the same time, it kept paying debt down, including $600 million of its government payroll support note. The quarter ended with $19.6 billion of available liquidity, total debt of $26.5 billion, and net leverage of 2.2 times, knocking on the door of an investment-grade rating. So what is it worth? At Friday's close of $115.41, United trades at about 10.8 times trailing earnings, while Delta, the other premium airline, trades near 14 times. A scenario-based discounted cash flow, free cash flow building from $1.6 billion this year toward $4.7 billion by 2030, a 9.5% discount rate, 2% terminal growth, implies roughly $130 to $150 per share in the base case, about $190 in the bull case, and $55 to $65 if fuel stays high and demand rolls over. To be clear, that is implied value under stated assumptions, not a price target and not investment advice. 3 things decide how this story goes from here. 1. Does the third quarter actually recover 80 to 90% of the fuel increase, like management promised? 2. Do fourth quarter yields, currently booking up about 19% year over year, hold as schedules finalize? And 3. The 2027 setup. At least 80 aircraft retirements, the MAX 10 finally arriving, and a path to double-digit pre-tax margins. This entire analysis was built using RoboSystems, a platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. If you want to do your own deep dives like this one, head to robosystems.ai, link in the description.